Have you ever wondered how economists get a comprehensive picture of an entire nation's economic activity? How do they tally up everything that is produced, earned, and spent within a country? It all starts with a foundational concept that reveals how these seemingly different aspects are actually interconnected. The national income accounting identity is a core principle in macroeconomics, stating that the total output of an economy must equal the total income earned in that economy, which in turn must also equal the total expenditure on that output. In simpler terms, everything produced generates income for someone, and that income is then spent on that production, creating a continuous flow. This identity holds true because of the circular flow of income within an economy. Every dollar spent by one person is a dollar earned by another. When we measure the economy's output, typically gross domestic product, or GDP, we can do so in three main ways. The expenditure approach sums up spending by households, businesses, government, and net exports. The income approach totals all income generated from production, such as wages, rent, interest, and profits. Finally, the output or production approach sums the value of all goods and services produced. These three measurements, when calculated correctly, will always yield the same result, acting as a crucial consistency check for economic data. Understanding this identity is vital for economists and policymakers alike. It allows them to analyze the structure of an economy and the relationships between its different sectors. For instance, if consumption spending falls, this identity helps us understand how that might impact income generation and overall output. It forms the bedrock for building more complex macroeconomic models that forecast economic trends and evaluate the impact of various policies. A key insight from this identity is recognizing that any change in one component, such as an increase in investment, inevitably leads to corresponding changes in income and output. It highlights how the components of an economy are intrinsically linked, demonstrating that an economy is a unified system where all parts influence each other. This is why economists often look at all three sides of the identity to get a complete and balanced view of economic performance. Ultimately, the national income accounting identity provides a powerful framework for understanding how an economy functions at its most fundamental level. By recognizing that production, income, and expenditure are simply different perspectives of the same economic reality, you gain a clearer and more robust understanding of a nation's economic health and how its various parts fit together.